Reintroducing Krish and Ananya for you for the purpose of this case study. Krish is a banking professional and he works with Citibank, whereas Ananya has a marketing job wherein she handles the brand Lakme for Hindustan Unilever. Ananya is an extremely organized and disciplined person, and she likes to save and invest as much as she can at a given point in time. Compared to her, Krish is a bit more messy and a bit more spendthrift when put in comparison with Ananya. Together they complement each other well like yin and yang, and they have a very good habit of discussing all the variables with respect to their finances before they take any decision of what is to be done with the money that they have in their bank account. Let's have a look at how they were managing their cash flows and how things changed around for them. When you look at the cash flows of a couple, the common questions that you would have is how many bank accounts do they have? Do they have a segregated account for income and expenses and a separate dedicated account for their investments? Have they added each other as joint account holders in their respective bank accounts? And do they transfer money to each other's account, or do they have a very set cash flow in place? When we look at the bank accounts that they both have, Krish has an ICICI bank account, which is his current salary account. He also has an account with SBI, which was the salary account of his previous employer, and he has an account with Bank of Maharashtra, which is opened by his parents. Ananya has a bank account with HDFC Bank, which is her salary account, and she also has an account with Sahakari Bhandari Cooperative Bank, which was opened by her parents for her when she had turned 18. They also have a joint account with Axis Bank, which they treat as their joint expense account. After learning the way in which they can manage their cash flows best, they realize that they have a little bit of work to do, and Krish goes ahead and closes his account with Bank of Maharashtra because it no more is being used by him and it has no role to play in his finances. And similarly, Ananya goes ahead and closes down the account that she has with the cooperative bank. Krish has a salary account in the form of ICICI Bank, and he decides to designate his SBI account as a individual investments account. Ananya has HDFC Bank as her salary account. She does not have a dedicated investments account and decides to open one with ICICI Bank so that she has a dedicated account to make her investments. They both already have a joint account in the form of an Axis Bank account. With this, they are able to put their bank accounts in place where each of them have a dedicated salary account, a dedicated individual investments account, and they have a joint expense account with Axis that will take care of their day-to-day expenses. With the bank account sorted, let's move on to see how much do they save and how much do they invest and how much do they spend on a monthly basis. When we look at their spendings each month, we can see that Krish spends for the entire rent on a monthly basis. He also pays the utilities, conveyance and the household help expenses, whereas Ananya spends for groceries and partly for her conveyance. Krish has a personal spend of 25,000 each month and Ananya has a spend of 10,000 each month. The total expenses they have is an amount of 1,20,000 each month, and the balance of 80,000 is what they save out of their earnings of 1 lakh per month for each of the two. Krish and Ananya decide to put the cash flows in place based on the most effective way to manage their day-to-day cash flows. You can see that whatever Krish earns in his salary account, that is an amount of INR 1 lakh, he transfers 40% or INR 40,000 each month to the SBI account, which is his individual investments account, and he transfers 60,000 each month to the Axis Bank account, which is their joint expense account. Ananya also does her part of transferring 60,000 each month to the joint expense account from her earnings of 1 lakh rupees per month, and she transfers the balance 40,000 per month into her individual investments account. With this cash flow put in place, they are pretty much sorted with respect to their expenses and their savings. Now, when they were looking at redoing their cash flows, they also wanted to do a quick check on a way in which they could reduce their tax liability. Some of the things they need to consider when looking at reducing their tax liability are whether they are managing their tax-free components in their respective salaries like HRA and LTA properly, whether they are claiming the reimbursable components of their salary with their respective employers, and do they have the habit of investing their respective earnings in each other's names, or they follow the right method of investing their respective earnings only in their own names. An analysis of their Form 16 reveals that the entire rent was being paid only by Krish, as a result of which he was claiming an HRA which was tax deductible only to an extent of 20,000 against the actual rent paid of 38,000. Now, as a result of claiming an HRA of 20,000 each month as tax-free against his HRA component, he was able to save a total tax of 48,000. Well, this wasn't the best way. They realized that a better way to do this is to split the rent between both Krish and Ananya so that both of them can claim the HRA that they receive from their respective employers as tax-free. So when both of them pay an equal rent of 19,000 each, they are able to claim a HRA deduction of 15,000 in their respective returns. So against the total HRA being claimed of 20,000, now they're able to claim 15,000 each. So their HRA claim increases to 30,000 and they are each able to save a tax amount of 36,000 per year. So just by splitting the rent between both of them and both of them claiming HRA in their respective returns, they're able to increase the total tax saved from 48,000 per year to 72,000 per year. This is the same strategy they need to follow for some of the other expenses like LTA. Leave trial allowance can be claimed by an individual twice in a block of 4 years. So if they plan well, every year when they go for an holiday, they can claim that as an LTA. For 2 years, Krish can claim the LTA in his income tax return, and for 2 years, Ananya can claim the LTA in her income tax return, allowing them to enjoy tax benefits on the holidays that they go on every year. Similarly, both of them have reimbursable components in their salary where things like telephone expenses and subscriptions for periodicals is being reimbursed by their respective employers. So both of them must ensure that they pay for these expenses from their accounts so that they can claim it as a reimbursement from their respective employers. A review of their bank accounts also showed that Krish had got a bonus in the previous year, and since he was afraid that he will spend the money if it was lying in his account, he transferred the money to Ananya, who then goes ahead and makes a FD in her name for the bonus of 2 lakhs that her husband had earned. Now what they didn't realize is that at the end of the year, when she earned an interest of 16,000 on that bonus amount which she made an FD in her name, it would technically have to go and get clubbed into the income of her husband that is in Krish's name, and this is going to add a little bit of complication to their income tax return. They realize that they will avoid doing such transfers in the future and invest the money which each person earns in their respective names to keep their taxation simple and clear.